Your hard-earned wealth is bleeding out into the hands of the ATO right now, and you don't even realize it. If you're over age 45 with more than $300,000 accumulated, your absolute complacency is costing you an absolute fortune this FI. It's an outright institutional crisis for your retirement pool. Listen to me very closely right now. You can legally pocket an estimated extra $45,000 before the deadline on the 30th of June. But the window of opportunity is shutting down completely. Are you seriously going to sit there and let the government take almost half of your hard-earned money? It's a massive wealth trap. And remember, this is educational information only. So keep your wits about you, because the game is rigged against those who don't know the rules. If you've got a massive balance inside standard industry funds or private options, you're currently target number 1 for the taxman's midnight raid. Let's dive straight into the brutal technical mechanics of how the ATO operates its collection system. The single most powerful weapon in your personal arsenal right now is maximizing your concessional contributions limit. For the current 2025-26 financial year, that absolute ceiling has been strictly set at $30,000. This isn't just a simple number written on a government website, Cat. It's your main escape route from the highest marginal tax brackets in the country. If your personal income pushes you past the $135,000 threshold, you're paying a massive 30% base tax rate plus the Medicare levy. Move over $190,000 and you're getting absolutely smashed at 45% on every single dollar you earn above that mark. It's total madness to accept that fate voluntarily. By utilizing a highly sophisticated salary sacrifice strategy, you can legally instruct your employer's payroll department to redirect a massive chunk of your pre-tax salary straight into your super fund. Instead of facing the devastating 45% marginal tax rate out in the cold, those pre-tax dollars are taxed at a flat, heavily discounted rate of just 15% inside your fund. That's an immediate, massive cash saving of 30% kept directly in your asset column. Why on earth hasn't your fund manager called you to explain this exact math? Because it's not their job to protect your family's personal wealth pipeline. General information only does not constitute personal financial, taxation, or legal advice. But wait, it gets significantly better for those with older balances who haven't maximized their caps over the previous 5 years. The ATO allows a beautiful mechanism called the carry-forward provisions. If your total superannuation balance was strictly under $500,000 on 30th June of the previous financial year, you can legally claw back every single cent of unused concessional cap space from the past 5 years and dump it all into this financial year as one single staggering tax deduction. We're talking about potentially injecting an extra $100,000 or more in a single transaction. Think about the massive structural tax offset that creates on your next personal tax return. It can completely wipe out an entire year's worth of heavy tax liabilities. Stop what you're doing right now. Look at your phone, log into your account, and check your exact balance. If you've been feeling the absolute burn of the cost of living, combined with high tax bills in Australia, drop a comment right below this video immediately and state your exact financial pain. Are you paying too much tax, or is your fund underperforming? Let's fix it. Now let's pivot directly to the second part of our operational strategy, because this is where most high-income earners get absolutely destroyed. If your total adjusted taxable income pushes past the strict $250,000 threshold, the ATO hits you with the dreaded Division 293 tax. This is an extra, highly aggressive 15% tax slapped directly onto your concessional contributions bringing your total internal fund tax rate up to 30%. Even at 30%, it's still significantly lower than the 47% top marginal bracket. But you must navigate this specific minefield with absolute precision to avoid major liquidity issues. Most wealthy Australians get caught completely off guard when the separate Division 293 bill drops into their MyGov inbox. Furthermore, we need to talk about where your capital is actually sitting right now. Millions of corporate professionals are trapped inside default retail funds that load them up with hidden management costs and trailing fees that eat away at performance. Moving your money strategically between industry funds and high-performance accounts requires meticulous timing before 30 June. If you don't audit your current fee structure today, those retail managers are essentially buying luxury yachts using your retirement dreams. But absolutely nothing compares to the catastrophic systemic trap known across the wealth management industry as the BPI death trap. This is the absolute peak of EUFE disasters. Wealthy individuals wait until 29 June or even the morning of 30th June to make their large, last-minute personal deductible contributions via BPI. They think because the money left their personal bank account before the midnight deadline, they're legally safe and entitled to the massive tax deduction. That's a fatal mistake. The clear, unyielding ATO rule states that contributions are only legally counted in the financial year. They are actually received and cleared by the Superfund's bank account, not when you hit the transfer button. BPI processing delays typically take 2 to 3 business days. If your $30,000 transfer arrives on the 1st of July, your deduction is completely disallowed for this year. Your current tax bill remains sky high, and you've accidentally ruined your contribution caps for the next financial year. It's an absolute financial nightmare that happens to thousands of unsuspecting Australians every single year. To completely bypass the BPA death trap, you must execute your manual electronic transfers no later than 23rd June to ensure absolute compliance and guaranteed clearance. Once the funds hit your account, you must immediately lodge a formal notice of intent to claim a tax deduction with your fund manager. Without that specific document processed and formally acknowledged by the fund before you file your tax return, your entire personal deduction will be instantly rejected by the ATO auditors. General information only does not constitute personal financial, taxation, or legal advice. The ultimate insider secret to unlocking maximum wealth efficiency this year lies in coordinating your bring forward rules alongside your concessional caps. If you have significant cash reserves sitting outside of superannuation in standard high-tax bank accounts, you can legally contribute up to $120,000 per year as a non-concessional contribution using after-tax money. Better yet, you can trigger the Bring Forward rule to invest up to $360,000 across a rolling 3-year window in one clean move. This immediately insulates your investment earnings inside a maximum 15% tax environment permanently. If you're sick and tired of watching your hard-earned wealth evaporate into thin air every single June, you need to prepare for our highly anticipated next episode, dropping this Thursday at exactly 7 p.m. In that critical broadcast we'll expose the hidden fee structures within the largest financial institutions in the country. General information only does not constitute personal financial, taxation, or legal advice. Make sure you subscribe to Aussie Super Secrets right now, hit that notification bell, and never give the taxman a single cent more than he legally deserves. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets. All rights reserved.